Kuala Lumpur, Reuters. Malaysia's Felda Global Ventures, FGV, the world's number 3 palm plantation operator, returned to profitability in the third quarter on increased production and predicted a further rise in output next year. The company reported a net profit of 38.8 million ringgit, $12.8 million, for the quarter ended September, compared with a loss of 73.6 million ringgit a year earlier, it said yesterday. FGV said its quarterly production of palm fresh fruit bunches, root FFB, grew 18% year-on-year, with its plantation operations also boosted by robust palm oil prices. Based on the significant improvement in our root FFB production for October, we expect FGV to perform better at the close of the financial year compared to 2016, Chief Executive Zakaria Arshad said in a statement. The profit came even as revenue dipped to 4.15 billion ringgit from 4.19 billion ringgit. FGV was hit by a management crisis in June when Zakaria was forced to step aside during an investigation, initiated by the firm's chairman at the time, into transactions at a subsidiary. But the chairman later resigned and Zakaria, who denied any wrongdoing, was reinstated in mid-October following a 4-month leave of absence. FGV is targeting root FFB production of 4.3 million tons by year-end, with 2018 output seen at 4.86 million tons, Zakaria told a news conference. The company does not expect its production to be hurt by the La Niña weather event, which brings rains across Asia. We don't expect a serious La Niña. Even if there is, it's not as great an impact as El Niño. And it is, usually for a short period, said Palaniappan Swaminathan, Chief Operating Officer of Plantation Sector. Rains across palm oil plantations could potentially disrupt harvest and reduce production, but boost fruit yields in the longer term. A likely rise in output among producers could weigh on palm oil prices next year, said Zakaria. He expects the price of crude palm oil, currently around 2,600 ringgit per ton, to trade between 2,500 and 2,700 ringgit for the first half of 2018. Prices will drop next year as a lot of competition will come from soy oil, and also on recovery of output, Zakaria said. FGV's shares rose as much as 2.8% following the quarterly results, outperforming the broader market.